We don't often see this, but when it does happen, we need to be paying attention. Hello, ladies and gentlemen, and welcome back to a special edition of The Daily Show for stocks, commodities, and cryptos. We'll be covering all of those, including the macro data, news, and the latest, hottest chart levels. But I want to discuss today rotation because markets are starting to feel a little bit of financial stress. And when that happens, we tend to go into a recession. The jobs numbers didn't show it yet, but I want to talk to you about what happens next in markets. Let's get into it. Well, welcome back everyone to The Daily Show where we talk about markets, and we want to begin here by discussing all of the positives and negatives for the economies around the world. If it's your first time here, consider subscribing and of course smash the like button if you enjoy our content. Also wanted to just say a big thank you to everybody that's been sending my family well wishes. Yes, the birth of my son just happened a few days ago. It's why we missed a video, but I wanted to say a big thank you, massive shout out to the community for your support. And of course, we're bringing you content throughout this week. So don't worry, I'm not going anywhere. Let's begin by discussing recession threats, because this means that, of course, the stock market is now considering that they're not going to see bad news as good news anymore. It's been backwards. The Fed has been controlling this market, and bad news has been good news and good news has been bad news. Now, they say that you can never come out of a recession or a market until it goes the correct way, where bad news is bad and good news is good. So that usually shows you whether you're actually out of a recession or out of a downward market spiral. But let's discuss this a little bit because there's so many things to unpack. Let's begin by discussing how the economy looks as of today. And non-farm jobs payroll reports basically showed a pretty decent rise. I mean, obviously 236,000 versus expectations of 240. This was not much difference. And if you start scrolling through or you're looking at any of these reports, I think the most notable thing here is that we are starting to see a little bit of a decline when it comes to the number of actual jobs created by the US economy. That January looks to be a bit of an outlier and it started to cool off a little bit. This is what we call a lagging result. And we'll look at that a little bit later on because the jobs numbers are lagging anyway. And we know that there should be further compression on the US market based on a very simple chart that we'll show you a little bit later. Where were the jobs? Well, they all seem to come through professional business services, private education and health services, and a little bit more in leisure and hospitality. These are often the first to go as well. So we'd probably expect them to decline, though they tend to hire into, of course, times like summer. So that can be pretty standard. Now let's get into the really interesting chart. And this comes to whether we're bullish or bearish over the next little period here. And we've been very bullish now for the last two kind of weeks since we saw the Silicon Valley crisis and of course Credit Suisse, and the Federal Reserve pumped that liquidity back into the system because of course that has led to massive asset appreciation in things like technology stocks. Then we saw the markets hit critical resistance last week and started to show some signs of sell-off. And we've got some hot levels, I think, coming up, or actually they've just been hit on this market. But let's discuss this particular one. This is a huge switch over the last week. So as of last week, 33.3% of respondents over 6 months believed that the market would be bullish, 31 neutral, and 35 bearish. Now, if you go back to historical averages, this is starting to get into that very bullish camp. And whenever I see over 30% bullish, I usually start to go, whoa, 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 let's put the blinkers on. That tends to not lead into bullish sentiment over the next couple of weeks in markets. Just take a look here at the 29th of March survey result. 45.6% of people were bearish, 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 bearish. Do you see the trend of what the markets did? They went up. So this is a very important counter kind of argument here to what's going on in the markets. Let's now have a look at some other things that have just started to occur. The first one has to do with the jobs numbers. The jobs numbers are still hot. What does that mean? Well, it could mean that the Federal Reserve is going to have to do another hike. No pause yet, although I still think a pivot's basically, in the books now. It's whether it's this one or the next one. But the pause is now not expected, and 66.3%, upwards of 70% at one point, believe that there should be another 25 basis point hike in May from the Federal Reserve. So that's going to put a lot of, I think, issues into the market over the next coming months and probably further give us a higher chance of recession. We also know that smart money versus dumb money have crossed. And whenever we see this indication, we need to start paying a lot of attention. If markets keep rallying or dumb money keeps buying up and smart money keeps dropping, that gives us some similarities to other periods, which we'll talk about in a second. I really want to note out here some of the ones that I remember, which was August in particular, because August tended to show us a really bullish looking market, but it turns out it was fake. And that's what we're looking for. Can we see a fake market move that is trapping us as retail traders, investors, everything like that, into potentially buying the load of market while the rest are selling in? Well, let's have a look now at some other pretty interesting stuff. And I think one of those has to be when we talk about realistically this chart here, which is asset manager purchasing. So asset manager purchasing has been neutralized and really flat over the last couple of months. In fact, in 2023, they pushed it in Jan, sold it off in Feb. Guess what happened to the market? And recently, they've kind of remained relatively neutral. So I think that's the first chart that we look at. So if we take a look at the leverage traders over here, you'll see that leverage traders have started to net short the market similar to what they did in August 2022. They're almost net 600,000 negative in the markets. Now, this is happening again in April of 2023, and it led on to over a 15% decline in markets. So this is something that I think we need to be paying attention to. The money flow, or at least the leveraged hedge fund traders, they're starting to say there's something wrong here. We don't like this price. And although the VIX and other volatility markets are saying everything's cool, it's all great, we're going to a soft landing, the bonds market and the leveraged money is tending to lead towards that negative side. Let's have a look at some other indications. We've got here when retail sales go negative, a recession usually follows. Well, that's undisputable that tends to happen. We have turned that way. We also see US ISM manufacturing PMI going towards the negative side. Usually what has happened after that, a recession has followed. We know that 50% of all bond yields are also inverted at this point when they have been for a very long time, usually between 12 and 24 months. We have now just passed 12 months. We're on about month 13. We tend to see a US recession. So all of these things are pointing towards a recession now being there. Whether it's mild or whether it's a hard landing, we don't know. Of course, that's where the markets are really trying to figure out how bad this is going to be. Jobs numbers are starting to, they always look towards, at this stage, maybe the softer side, but they could get hard very, very quickly if things turn bad. We also can see here the McClellan oscillator has gone above 85. This usually leads to a kind of declining period or a sideways kangaroo style market in markets. It's not usually a great period of time to be buying. And we just saw that happen. So we tend to now lead into more of the negative side. You can see it only happens 1% of the time. And the annualized return after this happens is negative 3%. So it's something to be wary of in these markets. Let's talk about financial stress. Are we seeing it similar to other crash periods or other recessionary periods? Yes, it's gone past a threshold. We saw this basically back in the 90s. We saw it during the dot-com bubble. We saw it during COVID. And of course, we saw it during the financial crisis, the GFC. It's nowhere near as bad at this stage, but we're still getting those reads in. And that leads into most likely credit crunching. So we see here the credit outlook, which showing us again, there's a pretty decent chance that we're going into recession because we're getting credit crunching here going on across the board. And that tends to lead into, problematic times. So does the market believe this? Well, this is where you get this massive disparity between the stock market and the bonds market. I think it's always interesting to choose your side. If you are a stock market believer and you believe the stock market is more efficient than the bonds market in terms of figuring out recessions, then you would think it's all good because this is basically where we're at right now. But if we do see, we're following the no recession path, but if we do see the recession path, we theoretically should go lower at some point over the next 6 to 9 months, and that we should maybe even find a new low, which is what a lot of people are discussing. A compression of earnings will be the most likely reason. And that's why it's so important to follow channels like this one here. Remember to subscribe if you're interested in finding out more information this upcoming earnings season or even the next one, because the next one could really show some of the impacts of what the Federal Reserve has done to this market over the last coming months. Let's now move over to whether the market's cheap. Well, it's not really. 18.6 is not expensive, as it has been. This is forward earnings PE. Always use forward earnings, much better than current earnings. And what you'll notice is that it's showing us that it's not cheap, nor is it really expensive. So I like to buy things cheap. I'm sure you do too. I'm sure you like a good sale and a good deal. And you probably want the markets to be back in the 15s or 14s in terms of forward PE. We're just not there yet. So it's time to be cautious potentially in markets right now when you're thinking about what your next move is. And it comes back to this chart. So if we think about what happened recently, we basically have had the Fed hike impacts on the world and central banks across the world all hiking. Everyone's been hiking. Now that tends to lag into the economy. It takes like 6-12 months to really have massive impacts. And that's why there is this case to be saying, well, all these central banks need to pause because maybe they've done more damage than they even know that they've done. Silicon Valley Bank, Credit Suisse, they're examples of some of the damage coming through. So now we've got lagging Fed hike impacts, which we haven't seen probably in the economy yet, even in the jobs market. And now we have, as of probably about a month ago, tighter credit conditions. And that should bring forward effectively all these lagging impacts and make them felt by the economy sooner rather than later, which could be good if you're a bear because it means you may not have to wait as long. Now, when the Fed actually does pivot, which we know they're probably going to do very, very soon, then the average S&P 500 returns around those recessionary pivots, if it is a recession as well, haven't tended to be very good. Of course, we see here some of the reasons why markets have gone down, and we see here as well when we tend to turn. So this is going to be something interesting. I think the most big part here is probably the amount of months it takes. So you're looking at possibly that 9-month stint to the bottom if it follows similar curves. I tend to believe it won't. It might be faster than this based on the markets, but it's something to keep an eye out for. A lot of people are going towards the bullish signs, of course, of April. It's well known that April is one of the best months of the year to be in the markets. And if we do break certain highs we'll look at later in today's video, there's a good chance that we might continue to go up and we'll have to be waiting and looking at that. But let's now talk about both the pivot that's up and coming and what it means for markets, but also what the bonds market believes. So the bonds market about 2 to 3 weeks ago basically gave us an incredibly big reading. It said here the ratio of the VIX versus the bonds market volatility was big difference. And on one hand, the VIX believed everything was cool, smooth landing, everything's great. And that's why we've moved up as well. The Fed injection also helped that. But the bonds market is disagreeing with that. They're saying, I believe there's a lot of volatility coming and there's problems. And when we get these readings, these are some of the reads that you tend to see on markets. And I really do believe in the bonds market more than the stock market. I believe the stock market runs off fear and greed a lot, and the bonds market really thinks about risk a lot more. So when you're considering this, look at some of the reads we get over the next 12 months. It's a 50-50 coin flip, which in a positive market tends to be a very negative sign because traditionally markets are like 68% long, especially stock markets. So you can see some of the readings that we've had and some of the similar periods of time that we're at. Maybe it's something like this. Maybe it's more of a 2015, 16. Maybe it's more of a tech bubble kind of bust and we've got one last leg down. All of these readings, you can see where they happen. It's very 50-50, but no matter what, it hasn't tended to lead into exceptionally good returns when this has occurred. We also get pivots here, and I know people bring this chart up a lot, but usually we get a rally into the Fed pivot, which is exactly what we've seen this so far. So right now, and then we see the pivot and basically the markets go down. Now, I'm not saying it's 58% down or anything. Maybe it's 20, maybe it's 15, maybe it's just back down to the lows. We don't know that yet. But in terms of what generally happens, the Fed has always broken something in the economy and it always tends to lead into a bad kind of point for markets over the next 6 to 9 months. When we look at EPS as well, we know that EPS went negative. This will be something important as we lead into these Q1, Q2, etc. earnings. And we know that's one of the big charts. Also, equity risk. I've talked to so many bond managers, people that manage over $10 billion, and all of them are saying if you're not getting 9% in the markets, you're not even wanting to be in those markets right now. It's better to be in cash or bond or treasury style assets because they're just returning so amazingly. It's the best time in 13 years pretty much, or even longer, for bonds out there. And at least in my career, I can't really think, other than the global financial crisis, a time that you'd want to own traditional bonds more so than you would at some points that you've seen over the last couple of months. Let's now move over to what happened on the last trading session. This is where things get really interesting, everyone. We're getting rotation occurring. We're seeing utilities come through, something I warned and I talked about a lot here on the channel over the last month. I've said utilities, defensive, staples, healthcare, all of these types of things. And they finally started to come through. Yes, tech's been very, very good, but have a look at this. This is the 5-day rolling average. So energy did well thanks to, of course, OPEC, but we've now got healthcare and utilities, the top 2 performers over the last 5 days. And if you look at them on the charts, which we will later, we'll look at utilities, you'll see some pretty good performance there. So before we jump into the charts and we take a look at all of the key levels that you need to be watching right now, I want to say a big thank you to the sponsor of today's video, which is Tiger Brokers, and show you some of the things that this platform can help you with over the next coming weeks. Now, as many of you may be aware, we are coming into earnings season again, and that will mean that the markets will rotate into certain key areas. One of the things I love about Tiger's Brokers platform is being able to select the particular country that you are interested in trading, and then specifically drilling down into different concepts or different particular sectors. Now, Tiger Brokers has hundreds in here that you can select from, but I really like to look at the 20-day change and also the 5-day change to see where the money flow is going. You know, don't follow dumb money, follow smart money, follow the big flows, and you'll tend to do a lot better. Also, with earnings results coming up, you're going to need an economic calendar, and Tiger Brokers has you covered here. Whether it's daily, weekly, or monthly, or even needing to have the latest news, it's all been updated inside the platform with you being able to select the way that you want to view the month and all of the other information. You can also deselect IPOs, report announcements, or dividends, depending on what you're looking for. And as you'll notice here, I'm going to be looking very heavily at this particular week. The week of April 9th, we know the banks are coming out and a lot of eyes will be on this particular one. You can also select it to your watch list or positions open. So it just shows you those, which means that you don't have to go and filter through everything to look at it. So if you're interested in Tiger Brokers platform, why not consider checking them out? There's a whole bunch of special offers in the description down below, and there's some additional special offers out there for our Australian audience as well. I've managed to secure you only for a little bit longer, so you're going to have to open that account, an additional $30 worth of Tesla stock along with the extra bonuses, and all you have to do is open an account and fund it with as little as 1 cent. It's that easy. All right, well, let's jump back into the charts and talk about what's happened on these charts in particular. And I think the most interesting thing has to be yields. So the US 10-year held the low. Why did it hold the low? Well, the jobs numbers came in better or on expectation. So we didn't see a full-on collapse of yields, and we're seeing basically now the chance of another rate hike of 25 basis points becoming the reality of the May Fed meeting. So markets allocated for that. You can see it on the 2-year as well, and some of the yield curve also changed. And in terms of expectations of where rates are going to be, if we have a look now at the December rate, this is where the expectations are. You can see that little jump that came through, 4.4%. All of a sudden, a little bit less rate cuts than what we had a while ago. And I still think the market is probably overestimating how many rate cuts the Fed is going to do. The Fed have literally said on their dot plot, we will not cut in 24. That's what they're saying. Whereas the market's saying, oh, no, I think you're cutting. There's a great disparity there. And I think that's where the market's going to crack the most amount of, they're going to kind of crack the hissy fits later on if they don't get the support that they've come to expect from the Federal Reserve. And I believe the Federal Reserve needs to remain credible throughout this war on inflation. And that's what really it is. They have to stop inflation. If they don't, you're going to have serious ramifications long term. It'll come back. And all of a sudden, you've got the problem all over again, except this time it's even worse. Let's talk about high yields. They were up through the last session. We're looking for high yields to go down if stock markets go up. And that would show us something very, basically early. It would tell us that we need to be basically fading the rally. And if high yields go down, the stocks go down, that usually is pretty consistent. That means that it's probably a real move, and we can consider that there might be more to come. Let's move over here to copper. We're looking for Dr. Copper, basically one of the world's most used kind of industrial metals. So we need to look at this one and see whether it's high or not. We're looking at copper at roll reversal. We saw it break through our support. I've been negative on copper since literally right here, which has been a pretty good call, I'd say, so far. So that's around that January point. And I'm looking for copper weakness to continue. And if it does continue, then that shows us that we're most likely going into a recession. and also that we're going to see a slowdown through earnings. So watch the copper, and this is a very important chart. We'll continue to follow it. This one has been hard, and that's the US dollar. So the US dollar is getting all sorts of fighting on it. We've got BRICS attacking it. We've got all sorts of inflows and outflows and things being caused due to Silicon Valley Bank. And at the moment, of course, the trend has been down. And we reported on the trend probably switching here. But I've thought around this area we should have seen buyers. Now, the weekly closes right on some previous dojis, which shows us that we're at this kind of key neutralized level. I don't like the dollar trades at the moment. I really don't. I think that it's a bit tough. Maybe the easy short has been in. And this area here, I've just always thought there was buyers that could be committed. Now, this little close above 101.94 could be a sign of buyers recommitting. You do not want the market realistically too much underneath 101.43 now for the DX. So you really want to see it kind of hold this zone and then continue to rally off here. You can see here the 61.8 fib also sits on that low. So I think extreme lows for this week ideally would be here to see buyers recommence. This is a fairly interesting breakout, so certainly a level that's gone higher. I'd like to see buyers recommence and push these markets up. So that's what we're looking for here. Let's move over to gold, and gold did hit our key level up here at 2028 and actually sold off, went a little bit higher, 2032. I'd like to see gold maybe dollar strengthen and gold weaken back down into this really heavily traded area. We've talked a lot about 1976 to 1980. This zone here, we know a lot of traders bought and sold. Clearly the buyers were on the commitment side. So if the markets go down now, trend line through, I like a lot of confluence in this area. So I really like the 1980s zone from a technical scalp, technical day trade, find some levels, make your own decisions, of course, but that's a key zone that I'll be looking at. I want to just highlight silver here. Silver's moving on up. It's been doing pretty well. Now, traditionally, if you're having a really bad economy, silver should also be weakening, but it seems to be finding its second life here. It's coming back 25 almost for silver. We're approaching, again, pretty key resistance. It's going to move with gold, just more percentage-wise. So watch this one, but I think silver's big move has already occurred. I'd expect a little bit of a pullback from here. We'll move over to natural gas. Took a new low, so you can see on the weekly, just to give you an idea, took a new low and then ended up going back above it. That's fine. I mean, that's natural gas for you. It's what it does. We now have a very defined high, though. So we know that anything through this area, once we breach that, we should be looking at basically pullbacks being met by rallies. So we're really looking above that 2.2 kind of 8 level now for gas. And I still like this level as where, buyers should be committed, or at least are coming in. US oil, it's sitting right on that resistance still. You can see here again, if we highlight it up, the rectangular area of supply, we're waiting for it to really show us any signs of weakness or strength. This could be accumulation or distribution, so you've got to be careful. It's making a series of kind of like higher lows, and it did make that higher high, so that's the higher high. If you're looking towards the negative side, you really want to see this thing probably bust underneath $79, that is break underneath $79, then retest. Notice how the retest happens though. If it comes off with a massive wick rejection, then you might not want to try shorting it, but that would be the short. For the longers, you're looking probably for a take of something like 79.50, then instantly go back up. And if that happens, it'll blow through this level. I like oil a bit actually at these zones. I just want to see that reaction. Remember, we always practice patience, react, don't predict as much as possible in these markets. Let's move over to Tesla. Now, there's got some juicy levels on it this week with the Tesla. So let's have a look here at some of the juicy zones. And why I say they're kind of juicy is because there's some key levels, and I actually don't know why this didn't show up here, but it's actually more like down here. So this is the expected options low is actually down in this zone. Maybe I'll update them on Twitter a little bit later. I think my chart must have fallen off. But basically we have expected options highs sitting right around this heavily traded zone high up here. And we have the expected weekly options lows right around in this area as well. So we're basically, in fact, I think the expected options lows, if I remember rightly, were just, they were down here. This is actually where the white line was. So there you go, guys. You have to excuse me. I'm running on a little bit less sleep than usual because of the baby. So let's move over to this chart, and you can see here, basically we have a 61.8 pullback, but we have an expected weekly options low just underneath these little lows here. Now, if that comes down and instantly rejects it, I'm going to say that's a big watch reaction zone. I would set alerts and be aware of this area. And if you're trading Tesla, I think it's really well being aware of things sometimes, and that's going to be a big aware level. And then what I'm going to do is I'm going to actually pull a 61.8 fib from the high here down to the low we've currently seen. What you might notice is it hits right on a very heavily traded zone plus around that expected options high. So we've got that expected options high sitting right on a heavily traded zone, sitting right around a fib pullback. So if markets do rally, I expect sellers to recommit around 196 in terms of this market. I don't mind some of these key levels. It also makes sense from the option standpoint because, of course, while there's basically no options out there this week, we do know that 200 calls, they're always very strong in Tesla, and it's been fading that a lot to make sure retail traders don't get what they're meant to be getting, which is money. And yeah, that's what's been playing out. Let's look at some ratio style trades now. We'll start off here with IWM versus the SPY. Interesting point. Always good to have these long short style concepts on your chart. You'll see a few of them today. So Russell 2000 is very weak in comparison to the SPY. And yet if you have a look at what's going on with the S&P, it's kind of holding up a bit better. So is the Russell precursoring some interesting periods for the SPY? So if we actually load the SPY over the top and we look at some of these market points, okay, yes, this was the low on both, but look at where the S&P is. Look at where this combo is. It's not even near the lows. So it's a very interesting time here for markets when we're talking about basically where the Russell is in comparison, because the SPY should either be basing, which it could be, or it should be actually a little bit lower than it is right now. Is it artificially holding itself a little bit higher? Let's have a look at some other sectors, and we'll start off here with energy. Energy's at what I believe is a resistance. It had a great move through. Everyone gets bullish on it. It's obviously consolidating. Watch US oil a little bit as a precursor for this, but I do think it's at a period where it could easily short back off to fill some of the gaps that have been left behind in this rally. I don't really like it at this stage. Utilities, now big breakout for this one. I've reported on utilities several times over the last month, and it's done all the things you'd expect. It took a low, it did a nice pullback here. I particularly liked it there as a buy. I thought it was exceptionally good, and it's had a great return. So, it's not just always about tech like everybody thinks. I mean, that's 8.59%, nothing to sneeze at. It's actually hit my first target, so I'm very happy with that. And I'd like to see utilities go through for another couple of days, maybe 4 or 5 days, and then probably I would not be loving it so much after that. Let's move over to RSP. This is the equal weighted ETF of the S&P 500, and what you can see here is that the market is basically stabilized back at a 61.8 and a downward trend line and all these key things. And this is where you expect maybe some bears to show up again, and they're starting to. Remember, we take the tech out of it, we look at the underlying, that's what RSP shows us. So very nice technical resistance, and you're going to start seeing that across a lot of these markets right now. Let's have a look at the DAX. So the DAX broke below, not quite everything, but it did break below. It's a very heavily shorted market that doesn't like to short the old DAX, but it's back to a little bit of a key resistance. We look at the weekly here. We understand that, yes, the previous weekly did close high, but then we got a long leg doji. So we know we're either in distribution or accumulation. Which one is it? The break will show us. And this is across the board in so many markets right now. Let's have a look at them all. This is the ASX 200. I believe it's at resistance at this point. 7,200 was my level. So we're, 20 points above that. I liked it short from here. So we'll see whether it continues to short through. Again, this is another market overseas, obviously Australian market in this case, at critical resistance. Maybe it's going to find some weakness. Russell 2000 found a little bit of rally last week. Then it sold off again just down the lows here. Let's look at the weeklies just to get a bit of an idea of what's going on. And again, you can see here, until we find a kind of a price break and close above something like 1,810, we're not really feeling bullish on the Russell 2000. And if this does break below and close below 1,700, watch out. That's going to be a huge zone. Set alert, 1,700, big level. Let's look at the Qs. Watch reaction here zone. Absolutely tapped it. Then we saw, that's obviously my zone, but we did tap it and we saw a sell-off. We've come back to what we consider a standard role reversal, which is where we have resistances becoming support. It's found some buyers. Yeah, I don't know if they're real though. This is going to be critical. Actually closed here right on where I expect sellers to recommence, and That's a big deal. We've got gap fills also down below. So I'd actually like more that this to occur and then maybe find buyers. And you'll see why using the S&P 500. Russell 2000, US 100, you can see here the key level. You can see where it is. And again, I'd like to see sellers recommence here. Let's have a look now at this one. We'll just quickly chuck the watermark on there so you can see it. SPY, these are the expected weekly options highs and lows. These ones have been updated. So you can see here that the low 402 will make sense to some of the options levels, but I'd actually like to see something like this occur and then maybe close there, and then we can make more decisions based on that. But that would be, I think, preferable at this stage. Let's have a look at the SPX. What do we have? So we have a downward trend line, not my favorite. We've filled some key levels, which we hit. We definitely thought 41.35 to 41.50 was going to hold some bears, and they found the bears. And the question is, can it hold the bears? So that's going to be a big zone. We know that the Qs, if we go back to the Qs, if they start to break through 322 and close, we're probably moving higher. So you have to be open to this is where the bears have to recommit to these markets. And if we go back over to the futures market, you're going to notice quite a few key zones. So first up, we're at what I believe is a little resistance here. We've found shorters, we've found buyers. This should be where bears theoretically come back in. Now, of course, it's all statistics, so nothing's 100%, but it should be where bears come back in. Now, what do I like about the next point? Well, if we do sell off, we've got 1, 2, 3 gaps. So that's 1, 2, and 3 gaps down below. We now have a swing fib that sits in here. We've got our trend line, and we could easily spike low and go back up. And if we do that, then I think buyers would recommence. But what happens in this area here is going to be very, very important. I do feel like the bears should fade this and move it down. Could be wrong. I'm always prepared to be wrong, but when you're talking about statistics, I think percentage-wise, you'd have to like some of the things that you're seeing going on here. Let's have a look at the options market. Does that make sense? Well, we've got the 14th of April expectations, 420, 413, or whatever that is. Options calls. We've got a lot of calls outstanding. It's now become calls and puts, but the puts sit at 390. Everything in between here is big profit for the street. It's not a lot of calls or puts. I'm not paying too much attention to it this week, but it's the type of thing that makes sense. And that's why we've been holding. Wall Street's done an amazing job of the last year, realistically, making as much money as possible out of the options market. Now let's move over to Bitcoin. Now this is really interesting chart. I'm actually excited to see what happens on Bitcoin now. So we've got a long leg doji weekly, and now we open here. Now this means that we're either in distribution or accumulation. We've talked about 30,200 many, many times, but I also said that when I saw this particular candle here, I was open to the idea that this market actually might be distributing towards the sell. Now the reason why I'm opening to that is because look at these dailies. They keep not being able to hold any closure above these highs. So I'm looking to see whether the market actually wants to sell off again. Maybe alerts underneath 27,600 could be an early warning sign that this market actually started to tip over. I'm very interested in what happens here. It's making a series of higher lows. It's not showing significant weakness yet, but this is where I look and I'm super patient, and then I want to react to the market showing us the way. And it hasn't at the moment. You'd have to say it's still sustained in bullish trend on the higher time frames, and therefore 30,200 is still open. But I'm very, very, very fascinated by how this closes, because I want to know in the comments down below, do you think it's distribution or accumulation? At the moment, let me know. I'll see what you guys say, maybe feature you on the next video. Let's move over to the economic calendar moving forward. If we scroll through here, you'll notice, of course, we do have some bank holidays coming out for a couple of countries. If we scroll through, happy Easter to everybody as well, if you're still in that zone. And then Wednesday over here, we see the CPI numbers and core CPI. So that's going to be a pretty big bit of information. We know it always is one of the biggest bits of information for the month. We scroll down, we've got PPI. We've got also core retail sales. So this, and then UOM consumer sentiment. These are all New York Times. So there is a lot of news ahead, and obviously you're going to need to be very cautious this week, whether you're a scalper, day trader, or don't have proper risk management in the system. Thanks so much for watching, everybody. If you enjoyed today's video, please remember to smash that like button. I do expect probably the core CPI news to move this market a lot. There's decent volatility ranges. And yeah, if you're interested in a couple of free trading cheat sheets as well, you can jump on over to the link in the description and check that out. Also, do remember as well the sponsor of today's video, which is Tiger Brokers. If you're from Australia, take advantage of the offer. Why wouldn't you? You can fund it with as little as 1 cent, get an additional 30 Tesla fractional shares plus the others. And from other countries around the world, there's a bunch of special offers down below as well. Thanks so much for watching. We'll see you in the next one. Bye for now.